Good evening. Tonight we focus on Germany, the engine of Europe's economy, and a new set of numbers that matter to us all. Producer prices, what businesses pay each other for goods at the factory gate, are our topic. These prices are the first signal of inflation showing up before costs hit consumers. If it costs more for a car maker to buy steel, your next car will likely cost more too. Economists and central bankers watch these numbers closely to gauge economic health and set interest rates. Sudden spikes or drops in producer prices can warn of inflation or economic trouble ahead. Germany's Producer Price Index, or PPI, is a key measure for its vast manufacturing sector. Changes in German producer prices ripple across Europe and the world, affecting everything from electronics to machinery. The latest report from Germany's Statistics Office is more than numbers. It's a vital clue to the pressures businesses face and what consumers might pay next. Tonight, we'll break down what these figures mean for companies, workers, and you. We'll also explore why the numbers surprised experts and what that signals for the months ahead. Let's dive in. The latest data released today covers March 2026. German producer prices fell by 0.2% compared to March last year, a year-on-year drop. Even a small decline is significant. It means it's slightly cheaper for German businesses to buy goods from each other than a year ago. This continues a trend of deflation in producer prices, largely driven by lower energy costs. Cheaper energy relieves producers, and those savings move down the supply chain. But not all sectors are affected equally. Intermediate goods, like parts and materials, may have dropped more, while consumer goods like food and clothing stayed stable, or even rose. This variation shows that economic pressures differ across industries. The 0.2% drop is a snapshot of a cooling German economy, with inflationary pressures easing. But the real story is how this number compares to expert predictions. The small decline has sparked debate among economists. It suggests the German economy's path forward is more complex than expected. Let's see why. Here's the twist. Economists expected a bigger drop, 0.5%, but got only 0.2%. This miss forces a rethink of economic assumptions. Forecasts are built on data like energy prices and global demand, so a surprise like this means something unexpected is happening. It's a positive surprise, hinting at more resilience or pricing power in the German economy. The expectation was that weak demand and falling energy prices would push costs down faster. Instead, other forces are holding prices up. This smaller than expected drop has caught the attention of financial markets and policymakers. It challenges the idea of a rapidly cooling German economy. Prices are proving stickier than many thought. The key question: what's behind this resilience? Let's unpack the reasons. Why didn't prices fall further? Several factors are at play. First, rising labor costs. German unions have secured significant wage increases, raising company expenses. Higher wages make businesses less willing to cut prices, even if energy costs drop. Second, demand in some sectors may be firmer than expected. Orders for specialized machinery, for example, could be up. Even small demand increases give producers confidence to hold prices steady. Third, supply chain issues linger. Some raw materials or components still face bottlenecks or higher shipping costs. These frictions add to costs, making companies less likely to pass on savings. Finally, after years of inflation, businesses may be testing how much customers will pay, keeping prices firm in anticipation of better times. This combination of wage pressure, selective demand, supply chain friction, and price-setting behavior explains the stickiness. It's a complex picture, but it helps us understand why prices aren't falling faster. Now, what does this mean for German companies? For German companies, a mild price drop is a mixed blessing. It avoids the dangers of deflation, where falling prices can trigger a downward spiral of delayed purchases and shrinking profits. But sticky prices, driven by higher wages and costs, squeeze profit margins. companies must balance rising labor costs with limited ability to raise their own prices. This is especially tough for export-oriented firms competing globally. If German production costs stay high, they risk losing market share to cheaper rivals abroad. The famed Mittelstand, Germany's small and medium-sized businesses, face this challenge daily. In response, expect a renewed focus on efficiency, automation, and innovation. Companies will invest in advanced technologies to offset costs and move up the value chain. The current environment will accelerate this push for higher quality and productivity. It's a classic German response to economic pressure. Let's turn to the workforce. Recent wage gains are good news for workers, boosting their purchasing power amid high living costs. But higher labor costs can pressure company profits, potentially slowing hiring or even leading to job cuts if margins get too tight. This creates a delicate balance. Fair wages versus job security. Producer price data will shape future wage negotiations, with companies citing tight margins and unions pointing to productivity. The outcome will affect both inflation and employment. Meanwhile, the drive for efficiency and automation could reshape the job market. Some roles may disappear, but new, higher-skilled jobs will emerge. This transition makes retraining and upskilling essential. Investment in education and training will be crucial for workers to adapt. The current climate highlights the urgency of preparing for an automated future. What does all this mean for consumers? In theory, lower producer prices should eventually lead to lower prices in stores. The 0.2% drop suggests less pressure for prices to rise, a relief for households facing high costs. But the link isn't immediate. There's often a lag before savings reach consumers. And since the drop was small, don't expect dramatic discounts. Instead, price inflation will likely cool, with slower increases for goods. However, rising wages mean service prices, like haircuts or restaurant meals, may stay high or even rise. So, while manufactured goods may stabilize, services could keep household budgets tight. Wage gains are positive, but their real value depends on consumer prices. If inflation stays low, households will see real improvements in living standards. This could boost consumer confidence and spending, supporting the broader economy. These numbers are a key indicator of families' financial health. Germany's economic trends have global consequences. The smaller-than-expected drop in producer prices signals that inflation may be stickier worldwide. Central banks, including the ECB and the US Federal Reserve, are watching closely. For Germany's trading partners, stable prices mean German goods won't get cheaper as quickly, affecting their own inflation. Countries exporting to Germany may benefit from steady demand. Germany's health is a barometer for global trade and commodity markets. The ECB will weigh this data when deciding on interest rates, possibly delaying cuts. Globally, economies face similar challenges: fading energy shocks, wage pressures, and shifting demand. Germany's experience is a case study in the bumpy road from high inflation to stability. How it navigates sticky prices will offer lessons for policymakers worldwide. The world is watching Germany's next move. Let's bring it all together. In summary, Germany's modest 0.2% drop in producer prices was less than expected, revealing underlying economic resilience. Strong wage growth and steady demand are keeping prices from falling further. For companies, it means a focus on efficiency and innovation to protect profits. For workers, it's a win for wages, but a challenge for job security. For consumers, it signals stable goods prices, but persistent service costs. Globally, these numbers influence central bank decisions and reflect interconnected economies. They tell a story of tension between costs, wages, and prices. Understanding this helps us anticipate what's next for jobs, budgets, and the economy. A single report from Germany can echo worldwide. We'll keep watching these developments closely.